Sterling is moving closer to five-year highs after Bank of England Governor Mark Carney warned households, companies and the markets to prepare for an interest rate rise. And he said the first increase could happen sooner than markets currently expect. Chris Giles, our economics editor, joins us. Chris, these are the Bank of England Governor's first hawkish comments in almost a year into his job. What do they signal?
Well, I think they signal a real change of heart at the Bank of England, and in particular with the Governor Mark Carney himself, who's always been seen as on the dovish end, wanting to keep interest rates lower for longer. But I think he's recognised that the economy just has grown so much faster than he, the bank, or indeed anyone else expected over the past year, that now is the time to be really thinking quite hard about raising interest rates. And that's what the big change of heart is. And it was a very deliberate move to signal that he has moved his position.
So with this deliberate signal, what impact have we had on the markets? Let's bring up a graph to show some of that.
Well, I can think if you look at the right-hand side, you don't need to worry about the scale. This is the average interest rate expected over the next 6 months in the markets. And you can see it's basically a flat line until this morning, and it just shoots up. It happens at all other periods as well. And what it's saying is that where the market was expecting the first interest rate rise around March, April time next year, now this morning it's changed to be around November, December. And I think you've got to think about this as probably one of the months where there's an inflation report. So either November, more likely November or February.
And what kind of rate rises does this signal? Something more gradual once it starts?
Yes, I mean, one of the things that Mark Carney was very clear in his speech is that even if you're going to go earlier, and the Bank of England clearly is likely now to go earlier, say November, then it will hope that means it can go quite gradually, maybe a quarter of a percentage point every 3 months or so, and then not to a very high level. The bank is very much still saying interest rates aren't going back to what used to be considered standard around 5%, something much more like 2 to 3%. So really quite low interest rates for a long time still.
Low interest rates, but there'll still be concerns that with rising interest rates, it could hit the wider economy. I mean, clearly the focus here is the housing market in particular, but there must be worries there.
There are worries for some borrowers who've borrowed a lot of money, are very overextended still, and have been since 2007, and don't have necessarily very high incomes, so interest could become a very large part of that monthly outgoings. Now, these are not very many people in the UK, but there are some people for whom this will be particularly bad news.
And there's an impact on sterling as well.
Sterling has gone through the roof this morning, so we're seeing very sharp rises in sterling, both against the dollar and the euro. So in some ways, for other households who are wanting to go abroad in summer, this is actually rather good news.
But on the export-import front, it has a different picture.
It does. So for exporters who have been enjoying weak sterling for the past 6 years, this is going to be challenging, although it needs to be said that the sensitivity of exports and imports to the price of the currency in the last 6 years has been very weak. So it's quite likely that it's not as big as we would have previously thought, not as big as in the 1990s, for example.
Okay, well, Chris Giles, thank you very much. And for more on this and what Mark Carney is going to do over the next few months, please go to ft.com.